Hello, everyone. Geoffrey Nance here. Welcome to another edition of Tip Tuesday. So, we spent most of the month of April talking about how we can spring forward in our trading. Last week, we looked at an important part of life and trading in general, and that's the importance of taking rest. So, today I thought we would kind of talk about all right, so now, Jeffrey, I'm ready to get started. I do realize that rest is important, but now that I'm ready to go, what happens now that I get all excited? I do everything you talked about in April, and then the market just changes direction. So I'm all excited about doing this stuff. I'm all excited about getting started. And then here we are. I'm ready. I think the market's about to turn directions. And as soon as I get into a trade, it does the exact opposite. How do I deal with that? It's so frustrating. I sat on the sidelines. I waited patiently. I took some time off, and then I was ready to get back in the game. I was ready to jump in. And the first trade I make, it's like, what in the world? It couldn't be more opposite. Well, guys, this situation right here that I'm describing could have happened to you twice here in the last couple of days. So we knew that about 38.55 was where the bear market would have officially started, and the S&P got down to about 38.58. And when it hit that price point, it kind of stalled out there a little bit, and then it turned and it moved back up. So what if you were sitting out there going, wow, if we're going to be in a bear market, I know how to do some puts. So I'm going to go get in some puts because here comes the bear market. I don't want to miss out on puts during a bear market. Are you kidding me? So you jump into puts then, right? You get into puts, and all of a sudden, boom, market turns right back up, starts to move up 200, 300 points. You're like, what in the world? So then you think, wow, here we are. All right. So, the S&P's moved up, but things are still so negative out there in the economy that it's going to hit, say, the 10-day moving average yesterday, and it's going to turn down off of that. It's a reasonable thought. It makes sense a lot of times, but not this particular time. So you go out there and you get into puts, and all of a sudden you look up today and you're going, what in the world? The S&P is up almost 80 points today. The market's up 80 points. I thought it was going to drop. How do I handle this? What is going on here? So let's just say you did get into a trade. What would that look like? Well, you guys, you're going to have to stop out. So we're going to talk a little bit about what that looks like. So a stop out, and we'll use kind of this terminology a little bit interchangeably here. We'll call it a stop market. Your broker may just list it as a stop. It may be what we refer to as a stop loss. So the whole idea here is in our desire to try to win big and lose little. Losing little requires that we stop out of our trades. So if we're losing, what are we losing? Well, we're losing money. So remember, anytime you're buying something, it doesn't matter what it is. It could be a house, a car, a piece of paper, dirt. It doesn't matter. If you buy it and you're going to make a profit, you've got to sell it for a higher price. And if that doesn't happen, then you didn't make money. So it doesn't matter what it is that you're buying. If you're going to make a profit, you have to sell it for a higher price. So the same could be said for your options trading. Doesn't really matter whether we're talking spreads or whether we're talking just straight call or put options. If you buy something, in order to make profit, you're going to have to sell it for a higher price. And if that isn't happening, then you're not going to have a profit. You're going to have an expense. So we want your expenses to be as little as they can be. And one way that you can control your expense is by setting a stop loss. So remember, a stop loss means I want to stop losing. For instance, if you bought something at $4 and you thought it might move up to, say $5, and instead of moving up to $4, it dropped down to $3.95, $3.90, $3.85. It's just falling and falling and falling. What can you do? You can set a stop loss. And what we're going to do today is kind of walk through some options there, because it's basically two, and it doesn't really matter what broker you're using. There's essentially, it is most basic elements, two. Okay, two opportunities to stop out. So two types of stop losses. One is a stop market, and the other is a stop limit. Now, both of these are stop losses in to the extent that they are trying to keep you from losing more money in that particular position. So what is the difference between the stop market, stop limit? We're going to talk a little bit about that. I'm going to show you in the broker what this looks like, how you would set this up, and some options when it comes to as far as the expiration. So how long would this order be in place? And my charge for these orders, we're going to kind of walk through some of those things. So I'm going to share my screen here with you guys. And we'll just go in there and we're going to look at what this might look like. And it's really, I think what you're going to find is it's really pretty straightforward here for the most part. So let's just go over here. We'll pick a stock I think a lot of people are familiar with, Walmart. Okay, so Walmart's been in a little news here a little bit. In fact, I think they just had earnings today. All right. And it didn't go so well, by the way, guys. They did not like their earnings report, and Walmart is down quite a bit. So what does this look like on a chart? Well, it looks pretty rough, as you would expect. Yeah, look at that big dark candlestick on really high volume today. So Walmart is down really big. They really did not like this earnings report. So if you had owned stock in Walmart today, if you had owned a call option in Walmart, that's one of the reasons that we tell you, hey, be very careful about earnings reports. Get out before the earnings report comes out, because you just don't know what's going to happen. You might have been thinking Walmart's going to go up, $5 after their earnings report. Well, instead it dropped down almost $17. Well, that's, going to really hurt you. And so what we say is, look, just don't take that gamble. Just get out and be out of that trade and don't worry about it. But let's just say you were in that trade. Could you set a stop loss on the stock? Yes. But before we go any further, let me explain something to you. So let's just say you did own the stock when it closed on Monday at 148. And you said, all right, I want to try to make sure that if the stock really does move down after earnings, that I don't lose much money. So there is this thought out there, which is wrong, by the way, that you can just say, all right, if the stock is at 148, I'll just set a stop loss at 145. Okay, so let's go over what the stop loss is and what it isn't. So a stop loss is an order, it's an active order that says to the market makers, if the price reaches this number or lower. So if the price reaches this number or lower, I want you to sell my shares of this stock. So what a lot of people miss when we're talking about stop loss is that or lower part. So they just assume if I set a stop loss at 145, oh, the stock opened at 136. Whew, well, it's a good thing I had that order to sell at 145. Okay, it sells at your price or lower, which means right when the market opened this morning, your stop loss would have triggered at 145. So remember, at your price or lower. Well, 136 is way lower than 145. So it would have triggered and they would have sold all of your shares, but not at 145, at 136.58 or something really close to that. So the stop loss will not help you from a gap. Okay. So if a stock is going to gap, like obviously Walmart did today, the stop loss will not help you with that. Good news is that most stocks don't gap just on a regular basis, right? So you guys know that most of the time a stock gaps because of an earnings report, which is why we prefer that you avoid those, because you don't know whether it's going to gap up or down. It's just an unpredictable event, right? So it's not repeatable, not predictable, not reliable. We just say, well, I mess with it. So the stop loss would have triggered this morning, but it would have sold you not at 145, but at 136. So let's just say you had an option on McDonald's. You say I bought it for, $15, and I set a stop loss at 140. So now I bought it at $15. I set a stop loss at 14. Okay. Now that option opened at $10. I set a stop loss at 14. Is it going to sell me at 14 or is it going to sell me at 10? It's going to sell me at 10. Remember, a stop loss says at my price or lower. So now that we've talked about that, let me go into the actual option chain here. And I want to show you a little bit about how this works. So let's just say we'll just pick an option here. Now these options are short term, right? So don't get too caught up in that. But we're just going to pick one of these. It's the 130 strike here on Walmart. So 271. Now notice what this does is it populates essentially my order form. And I'm going to do this in two different setups here so you guys can see this. There are a lot of things I can control. We go over that and a lot of different things, obviously the quantity, the expirations, a number of things. But right over here is where I want you guys to really focus on right here. Order type. Now, guys, assuming, right, so we're not gonna enter a stop loss before we actually are in the trade, because it's a stop loss, stop losing. Well, you're not losing anything if you're not even in the trade. So the stop loss comes after you purchased a position. So let's just say we were already in Walmart now. We shouldn't have been, but let's just say we were, okay? We were in Walmart and I decided, all right, I'm going to go set a stop loss. So let's look and see what it says my options are. I have a stop market. Cool. I have a stop limit. Okay. Well, let's just click on stop market real quick and we're going to walk through what this is. So stop market, you'll notice it has a stop price. And then under this order, it says market. So let's talk a little bit about how a stop market works. So a stop market, which may or may not be listed as stop market in your broker, it may just simply say stop. A stop, if it just says stop, it is a stop market. And what that means is this order gets triggered if your price is at this or lower. So particularly if you're dealing with options, if the ask price is 271, right? We'll drop it down to 270. Say if it's 270 or lower, stop this out. Now, there are two things I could do here. I could do time and force as a day order, which simply means if this option price drops below 270 at some point in the day, just sell me out at a market price. So whatever price you can give me, just give me that price I want out of this trade. I'm tired of losing this thing. I'm tired of being in Walmart. I'm just getting crushed on this trade. I just want to be out of it. It's a day order. Now I can also make it a good till cancel order. Now that means it's simply going to stay there. It's going to be an active order until one of two things happens. One, I go in there and cancel it. Good till cancel, right? So I go in there, I cancel it. Or number two, it actually gets filled or executed. So in other words, I get stopped out of this trade. So one of those two things happens. It either fills the order and sells me out of the position, or I go in here and I cancel that order. So I've got a type of order, stop market, and a time enforced, either day order, in which case I would have to enter this, each day, or I can make it GTC. Now, do I get charged for an order that's a stop out? The short answer is no, you do not get charged for stop orders unless they become executed orders. So if they do get filled, then yes, you would be charged commissions if your broker charges you commissions for closing orders. But can you go in here and change your stop loss and the price of your stop loss multiple times? Absolutely. Can you do that without getting charged? Absolutely. Because again, remember, we're only going to get charged commissions for orders that are actually executed or filled. So I could have a stop loss in there, and if nothing happens, no charges for that. It just goes on. Now, notice the other option I have over here listed is a stop limit. Now, at Tradeway, we don't necessarily advocate using stop limits. Why is that? Well, let's see what happens. So you'll notice over here, when I put in a stop limit, now I have to fill in two blanks. So what is going on here? Well, the first one is my trigger price. So what I would do here is I would say, all right, if the ask price gets to say 270, then I want you to sell my option for 265. But here's the tricky part here, guys. When you enter this limit order, it says to them, you have to sell me at 265 or higher. Now, remember, a market order is just immediate. So you say, well, once it triggers at 270, then just sell me. Whatever the difference is between the bid and the ask, I just want out of this trade immediately. Boom, it's over, it's done. With a stop limit, you might say, oh, wow, Walmart was just getting crushed today. it's a good thing I had my stop limit on it because now I sold out and I got, a good price. Well, here's the thing. Remember, a limit order is a negotiated order. So the market maker has to be willing to take your price. So even though your order gets triggered when the ask price is 270, what if they don't want to close you out at 265? Remember, you're in negotiations with them, but you're like, Geoffrey, I thought this was an automated order. Well, it is, but you're dealing with them with a stop limit and they're having to agree to your price. So it's possible when using a stop limit that you could enter this order and then actually not get stopped out of this trade. So you might have still been in this trade even though you thought you got out. So a stop market, okay, you enter the price, and once it's that price or lower, it executes. You may not get the best price, but you'll be out of that trade. A stop limit, yes, you might get a better price, but you also might still be in that trade. A little tricky there, so be careful with that, whereas a stop market, again, is going to sell you out at that price. Okay. All right, so we'll go over here real quick. We'll look at one other broker. Now, this is the charts by Tradeway. So if we go over here to our option chain, we'll go type in Walmart again, just to keep everything the same. We'll go over here to options. We'll just click on, we use today's or Friday's expiration, so we'll use it here as well. Well, you'll notice similar setup here. I think we were looking at the 130 here. Let's just say you were in this, right? So you bought it here. Okay. All right. So you bought that thing, and now you'd say, all right, I was in that trade. It's going to look a little different here because I'm not actually, doing this, and it sets up a little bit different than your other brokers. But you would say, all right, so I'm in this position. You would be able to click on your position, and then you would go in there and you would set, again, a stop order. And this would be a stop losing. So I want to stop losing. So how does that look? You say, well, I want to do a stop market. And you enter that stop market. And if that price dropped below the price that you entered, then you would be stopping out of that trade. Now, does anybody really want to stop out of a trade? No. All right. Just on the surface, we say, well, no, I don't want to stop out because that means I lost money. Well, here's the thing, guys. We do want to stop out. What? Why would I want to stop out, Geoffrey? Because stopping out indicates that you were willing to lose little. More often than not, if you say, Geoffrey, I don't want to stop out, that means that you're actually going to lose big. So you're still going to have an expense. You're eventually going to sell, but you're just going to sell for a much bigger expense. And in the long run, guys, stopping out and losing little is way better than not stopping out and losing big. Okay? So win big, lose little. How do I do that? Well, one of the ways you can do that is by setting a stop market. Okay, so once you go in here, you find this stuff, and you can go in there and you just hit stop market like we discussed and stop out of that trade. Now, your broker is going to look a little different depending on what you're using. They're all a little different, but most of them are going to be fairly similar, and that they're going to have that option once you've entered that position to click on your positions or to go in there and find what you're in. And just click somewhere on it, and then you'll see it pop up. And then most of the time, it's going to, do the opposite of what you did to get in. So assuming that we bought here, it would say, okay, you bought, so now you must be willing to sell. What does that look like? And then it would look like what we discussed earlier. All right. So that is a stop loss, guys. And no, it's not fun to stop out, but guess what? It's necessary to stop out. And if you're going to trade for a long enough time and you want to have better results, you have to realize, yes, you want to win big. All of us would choose winning big over losing even little. But losing little is way better than losing big. And so as you get started, as you move forward, you're going to have expenses, guys. It doesn't matter how good you're going to be. It doesn't. You're still going to have some expenses most likely. And we want those to be as small as possible. So want you to get excited. We want you to get in the game, but we also want you to realize, hey, when you get in there, this play doesn't work, stock doesn't move the direction that you thought. Now you've got to take an expense. At least let it be a small expense, and you can handle those with those stop markets. All right. That's our tip for today, guys. Thank you for being here and being a part of Tip Tuesday. We'll see you next time.